Hi everyone, welcome back to my channel. Today we're going to be talking about how to turn a 30-year note into a 15-year note. If you're looking to pay off your mortgage faster, you may want to consider changing your 30-year loan into a 15-year loan. I have 10 different options that you may want to consider. My name is Dianne Ayala Steffey. I am a mortgage loan expert. I work with clients to first educate them on the various financing options available to them. The first step is understanding your current mortgage. You need to know the type of loan that you have, the loan amount, the interest rate, how many more years you have left on your mortgage. Before you even start looking to see whether this is a good step to take, you need to understand your mortgage, how much you plan to save, what is going to be that threshold of whether that's enough money. $50 may be a lot for some people, $50 may not be enough on a monthly basis, so we need to compare to see how this is a good investment for you. So the first step is to understand your current mortgage. You need to know your loan amount, loan type, your balance, what monthly payment, what interest rate you're at. So that way we can do a thorough analysis of your goals and getting that mortgage payment lowered, or if you wanted to change that term. One of the biggest benefits of a 15-year note is the interest rate. Typically, the interest rate is lower than a 30-year note. But even though it may be lower, you're shortening the term period in that note, thereby increasing your potential monthly payment. So when you look at the loan type or the interest rate, you need to consider whether you're going to be able to afford that 15-year note. It is a savings, but it could be a little bit more out of your budget. So you need to consider whether it's going to fit your budget and whether it's going to meet your goals. When you go from a 30-year note to a 15-year note, don't look at that as an expense. It actually is a savings to you, because if you shorten the period from a 30-year note to a 15-year note, you're saving hundreds of thousands of dollars in interest payments. So you should consider that as a savings to you versus an expense. So when you're planning to go from a 30 to 15-year note, even though the interest rate is lower, you have to consider that the monthly payment is going to be higher because you're shortening that period from a 30-year note to a 15-year note. So that expense, or actually that increase, should be considered in your budget. If you can budget that amount of money, then you're going to be better off doing a 15-year note versus a 30. When we look at refinancing a home, of course, we're going to look at your goals. We're going to make sure that you qualify for it. We want to make sure that you understand that going from a 30 to a 15-year note is going to increase your overall mortgage payment, but in the long run, it's going to be a savings. But when we refinance it, we want to make sure that your property will appraise so that you'll be able to refinance your home, rolling in any potential closing costs that may incur as a result of refinancing your home. Refinancing your home will incur closing costs. Very similar to when you purchase a home. The only thing is that you own the home already. You're going to be using the appraised value to refinance your home. So hopefully you can get out if you're in a loan that has PMI, private mortgage insurance, or if you're in an FHA loan, which is mortgage insurance premium, that there's enough value or enough appreciation in your home that you can refinance and remove those particular types of insurance products. So that's a benefit for refinancing your home. But there are going to be expenses involved. One thing that you will incur is the expense of putting in or possibly rolling in your escrow accounts, which is your insurance and your property taxes. So if you can come to closing with those items, you're going to be able to benefit a lot more than if you roll that in, depending upon the appreciation or the value of your home. When I speak with a prospective borrower who is looking to refinance their home, I do a full, complete financial analysis to make sure that this is the best thing for them to do. If the interest rate isn't low enough so that there's a benefit to the borrower, then it's not going to be something that I'm going to advise that particular client to do. It's really important that we look at the total picture and then advise the client as to when would be an appropriate time for them to refinance their home. But there are a number of aspects. We want to look at your goals. We want to look at the appraised value. We want to look at the interest rate. We want to make sure that you're taking the right step towards this, but we want to make sure that we put you into the right type of loan, so that way you're not incurring or we're churning a loan, meaning that we're just refinancing so that we can put that money into our pockets as far as commissions. I always want to make sure that my clients are taken care of 100%. There are no prepayment penalties on any traditional loans. For example, traditional loans are FHA, VA, conventional, jumbo loans, or USDA loans. Those are traditional loans that do not have any type of prepayment penalties. However, sometimes you have what's called non-QM or qualified mortgage that may potentially have that. So we want to make sure that when we do refinance your home, that we know the type of loan that you have, so that way, when you're considering a 30 to 15-year note, we want to make sure that it's not a non-QM loan, and if it is, we want to look at the note to make sure that there are no prepayment penalties involved. If you're refinancing your home from a 30 to 15-year note, you will be in a fixed 15-year note, so you have to make sure that you're making that mortgage payment on time every single month. You're not going to have that availability to stop paying on your 15-year note unless you refinance back into a 30, but that would defeat the purpose of why you're considering doing a 30 to a 15-year note. So if you're not refinancing and you want to self-discipline by paying an extra payment and creating it as a 15-year note, you need to be disciplined. You need to do it automatically, so that way you're not tempted to revert back to a 30-year payment. If you're seriously considering this as an option, you need to speak to someone that is a professional, that understands all the steps involved in going from a 30 to a 15-year note. You need to speak to a mortgage expert, not someone that'll just take your loan application and just do what you want them to do. You want somebody who is knowledgeable, experienced, and then can give you their expertise, someone like me. So call me. So when you're looking at or considering a 30-year to a 15-year note, make sure that you think of it as a savings. It's not an expense, it's a savings, because when your home is appreciating in value and you paying it a lot sooner, your appreciation in your home is growing that much faster. That's it for today's video. I hope that you found these tips helpful. As always, please leave your comments and questions in the section below. Don't forget to subscribe for more mortgage tips.